Hi, this is Brian Resney, President of Resney Wealth Management. I'm bringing an important update specifically about the bond market and income investors, retirees. What I'm finding right now is a lot of retirees are unfortunately investing with greed. Interest rates are low. Interest rates eventually will move up. We will have an inflationary environment from the Federal Reserve printing as much money as they had. Remember, investors invest with two key emotions, fear and greed, and unfortunately, neither one of those work in an investment strategy or for your retirement. When I talk about the greed factor, retirees are chasing yield because interest rates are down. They're doing whatever they can to get higher rates of return or interest on their money. A couple weeks ago, Goldman Sachs issued 50-year bonds at about 6.125% interest. Investors flocked to that bond, over 5 times subscribed, meaning Goldman Sachs actually issued more bond by 5 times than they thought they were going to. That is the biggest mistake, in my opinion, investors can make, is buy long-term bonds in a low interest rate environment, especially 50-year bonds. These 50-year bonds could easily lose 12 to 15% of their value or more every time interest rates go up. Now, I know what you're saying. If I buy a 30-year bond, Brian, and I keep it to maturity, don't I get my money? Sure you do. The problem is, if you buy a 30-year bond that's currently paying, let's say, 4% interest rate, and interest rates go up by 2 percentage points over the next 3 years. The problem is, the next 27 years, you're making 4%. When the other investor, or the wise investor, bought short-term bonds now, let those bonds mature or sold them prior to maturity with very little principal fluctuation, then invest in the next 10, 20, or 30-year bond that then is paying 6%. So now for the next 27 years, you're getting 4%, while investor B, the non-greed factor investor, actually invests wisely, and now when rates go up, he invests in a long-term bond. He's now getting 6% or 2% higher than the 4% investor for 27 more years. So sure, you can keep that bond to maturity, and you'll get your money back as long as that company doesn't go out of business. But the fact of life is, if you are making 2% less every year then for 27 years, how much did you ultimately lose? Bottom line, when rates are low, buy shorter term duration bonds under 5 years. When rates are at historical average highs or very high, you would then move into medium and long-term bonds. We've already positioned our clients correctly for the bond market. We don't want devastation in our bond portfolio for our clients. Unfortunately, many investors who, again, key emotion was greed and fear, with the fear factor, sold out of equity markets at the low or reduced their equity exposure because they thought everything was going to zero at exactly the wrong time, only to buy bonds at exactly the wrong time. So one emotion created obviously a loss in the portfolio. The next emotion is going to create another loss, in my opinion, when the bond market collapses from rising interest rates because of inflation and the Federal Reserve on their mandate on keeping rates low. That ultimately will drive asset prices higher, equity-based investments such as the stock market. This is Brian Resney. If you need a second opinion about your portfolio, it doesn't hurt to talk. If you're concerned about your money, if the advice you're getting isn't really advice at all, and you'd like to work with a fee-only money manager, somebody who actually has a disciplined investment strategy, and a way to reduce risk in your portfolio in down markets, give us a call. We'd love to get your portfolio back on track. But remember, greed and fear are very poor investment strategies, and both of those will create havoc in your investment and retirement portfolio. Have yourself a very profitable day.